Good evening, everyone, and thank you for joining. I hope you can hear and see me properly. If you can, please let me know on the chat. Before we start, I know the past few weeks has been intense. Many made maybe great trades, but maybe others felt like things haven't behaved the way they should. So hopefully today we'll try to maybe not add more information, but maybe simplify what actually matters. I just want to make sure that you can hear me properly to move forward. We'll have a quick presentation, then we'll also check the chart. Please remember this is a live session. It will remain live or it will remain on YouTube even when the live is done. But you can benefit from that. You can ask me any question. If you're trading this week, also please do let me know. We can check um, the charts with you. Just want to make sure the audio is fine and we can proceed. So, how we'll maybe focus this week or this month is the story that three key assets is telling us. When we link the story of these three main assets, which is definitely the oil, gold, but most importantly, the USD. Why the USD? Because even though the headlines are talking about war, they're talking about energy shock, but the main story we believe is in the liquidity. And that's probably what a lot of traders missed and why they couldn't understand what's happening in the markets and why others made great profit. Um, Maybe moving away from the noise. So quickly we'll look into today's agenda. It will be quick. We'll see the setup. What does this geopolitical escalation means to the market? And the core of it, obviously, it's oil. The price of oil. Everybody discussing different levels, whether it's 150, 200, below 100. So how are we pricing oil at the moment, and is the pricing the reality of the market, or maybe it's the fear, maybe it's less? Then definitely we'll focus on gold, safe havens in general, but obviously gold, sorry, why it's acting the way it is, how come it's not peaking the way it should be for, or what others maybe expected. But the main story will be USD and the liquidity, which is, we believe, is the real drive behind cross assets. Then we'll look at equities and where they will move next. So the setup, to look quickly at that, obviously Iran's escalation has sent shockwaves through energy market. And why do we care that much about the energy market? Because since COVID, we've been trying to fight inflation. And when it comes to energy, if prices go up, everything else goes up. Energy is needed in almost everything in our daily life and in the economy. So obviously, it will affect inflation expectations. And by that, we definitely see some effect on the risk sentiment. Um, why is this area super important when we're discussing Hormuz? Because over quarter of the global oil supply passes by this supply chain. And when this happened and this interruption happened, we had to see capital reallocating in real time under stress in a very short time frame. And that's the main story right now. And um, if you remember, or if you go back like a month before, everybody was asking, where do I park my cash? That was the main question. Everybody wanted to know what to do with their cash. Nobody wanted cash. Nobody wanted the US dollar. It was under pressure. And this is why we saw a lot of assets near all times high, a lot of overbought assets. So when a shock like that happens quickly with no maybe signs, and the exit door is super small, we'll definitely see a quick reallocation under pressure. So even though prices of oil jumped, even though Brent is above 100, these are probably 2 days ago, the prices, they're a bit old. By why I'm keeping them? Because of the link between the different benchmarks. But then the standard benchmarks You can see how different they are if we're seeing or if we're comparing between the Western oil crude and the local crude oil that's mainly being affected by Hormuz. And if you can see, Brent now is around 100, WTI is a bit lower. And if we compare it to Oman crude oil, where we're seeing prices above $170, Dubai above 150 at some point. These are levels that we didn't even see when the shock of Russia-Ukraine war happened, the shock of 2008 happened. So that's not something sustainable. The difference between these benchmarks are not sustainable. And what we believe is obviously because when it comes to the US and when it comes to um, just give me 1 second to Brent price, it's definitely being capped by the reserves that wouldn't last for long. We don't believe that, or we don't think that the supply shock is being priced fully at the moment, especially when it comes to the Western benchmarks. Keep that in mind. It might be one of the key reasons why oil prices might continue their uptrend. Even when we compare Brent and US crude oil, the spread that we're seeing between these two benchmark, it's the widest since 2013. Why do we care about the spread? It's never, it never lags for long. So now we know there should be very soon a moment where either, obviously Europe is, when it comes to who is suffering more, let's say from this oil supply shock, Asian countries first, Europe next, then the US, and we can see that with the prices of the benchmarks, Europe is absorbing the shock probably faster than the US, and then we will see it unfolding. That's why we think oil strength is not exhausted yet. Maybe what we're hearing from Trump is a way to try to postpone the shock, a way to gain time, figure out solutions. So let's keep that in mind. But then, in case no solutions come, the spike that we saw in crude oil in the region might also be next reflected on European and other Western benchmarks. Now, gold, obviously, it's a paradox. For so long, all traders or uh, investors believe that once we have a geopolitical tension, obviously gold should spike. But despite the geopolitical escalation and the oil shocks and the higher volatility, we saw gold declining. Now gold, will also check the charts, is almost close to the bear market. I think there's definitely this traditional assumption that gold automatically rise in periods of uncertainty, but that's not always the case. Please keep in mind that reality, and maybe we need to zoom out a little bit. There's definitely a shift when it comes to what's driving the market. Gold is not reacting only to fears, it's not reacting to potential um, tensions. It's reacting primarily to global capital flows, especially when it comes to oil exporting countries, like the countries here in the GCC. Historically, they've been key buyers of gold. So now, when they're faced with probable reduction of revenues, there's definitely some shrinking and buying capacity. Um, Even at some cases selling. And we can see that also China, by the way. China was one of the bigger or the biggest buyers of gold. But also at this time, when we're expecting a slower growth, China should be reducing their reserve accumulation, maybe even selling some of it. And we can see that the window when we saw this huge drop in gold during the Asian session on Monday, so Asian session, it means, the biggest exposure would come from China or even from countries in the GCC. And as you can see here, the biggest purchasers of gold was definitely China, Asian countries, uh, and Middle Eastern countries. So obviously, any changes in that behavior would be highly reflected on prices, and it's confirmed also because when it comes to data coming from big banks or central banks, usually they lag by 2 or 3 months, so we don't have specific data to confirm this point of view. But obviously, because we've seen this drop during the Asian session on a Monday when the markets opened, as well as knowing who the biggest buyers of gold were for the last couple of months, we can expect, especially what's happening right now, that they've hold, like they've been on hold, or maybe they sell some of their reserves. So is this the end of the uptrend or the momentum for gold? We need to first look at the two main drives of gold demand for the last couple of years. First of all, obviously, it was the quantitative easing, how much liquidity there was in the market. And that's also linked to the fact that everybody wanted to invest in the last couple of weeks, let's say, everybody, or month even, or years. Everybody wanted to use the easy cash that they had to invest in something. And that's definitely because of, even real rates, even with the interest rate being around 3 or 4% globally. But then if we adjust them to inflation, which gives us the real rates, they were negative. So gold obviously was a clear store of value. Besides that, and the most important thing, was the shift that we saw in global markets towards de-dollarization, moving away from dollar, whether it was Russia, especially it started with, when war happened between Russia and Ukraine, and Russia realized that it needs maybe like another way to deal with the world outside of the US dollar. So gold definitely gained from that shift. China as well, GCC as well, they shifted the reserves away from the US dollar into gold. So these two structural drives, they are now under test. We're not saying that it's no longer, the case, but what changed is, first, as we said, lower oil revenues when it comes to GCC, and also weaker demand probably from Asian countries, especially China, who was the biggest gold accumulator um, in the last 5 years. So both scenarios made the pressure on gold super clear. Then obviously the ETFs followed. As we can see, what happened last Monday brought the outflows of gold out of ETFs to its lowest, or the highest level, the outflows never seen since 2013. You can see how deep the spike was. It's a clear shift in sentiment. We'll also check the charts. If you have any questions, also please do let me know. If you're in a certain trade, also we can have a look together. Um, Joy from IG also, she is with us on the live stream to check your questions and help you in case you have any uh, inquiries. So now to the most important part of the market, the US dollar at the core of everything. Obviously, the initiator is oil, it's the headlines, but then the US dollar and liquidity, they are at the core, and they are the core drive of everything happening right now. Why are we saying this? Because all cross asset moves trace back to the US dollar, especially when it comes to oil. Oil is sold. The middleman in oil trade is dollar. There's the petrodollar, the link between the dollar and the oil. So obviously, when demand for oil spikes, demand for dollar spikes. At some point, we've seen that some countries were trying to bypass that to buy and sell oil in their own currency, or maybe with gold. And maybe that brings us back to one of the reasons why the US is in this war, is probably, or how it's benefiting from it when it comes to, the economic part of it, is that the US dollar is back being the main middleman for whoever wants to buy and sell their oil. Even Russia now, I believe they are using the US dollar in their oil selling and purchases. So now we have oil shocks, oil prices higher. the US, the dollar, the demand for the US dollar is higher. But at the same time, when we're talking about oil shock, then we're definitely expecting inflation to rise, and the inflation risk rising would definitely support a potential more hawkish Fed, higher rates, or at least fewer rate cuts. That's also supporting the US dollar. And then we have the tightening liquidity across the system. Everybody wants their cash back. Private credit is under pressure, and that's also a story that's not being maybe highlighted enough. But we've seen over 10 billion, or even over that, dollars in withdrawal um, last month. So that's pressure. Um, Funding conditions are tightening globally. So that's the main story. That's why we believe we need to be focusing on how there's a liquidity squeeze globally led by the US dollar strength, the demand on the US dollar, whether because we want to buy oil, whether because we want to hold from overbought trades that we've been in. So that's the story of uh, the strong dollar. Trump is trying to ease that with another 10 days of no attacks on energy infrastructure in Iran. But then again, the result of all of that is gold dropping, risk assets holding, but they are still under pressure, borrowing costs rising, and that's definitely not a good story for equities. Does that mean we need to sell our equities, or this dip was a good entry point to buy the dip? So we believe equities is under stress. It's not breaking down yet, especially when there's different uh, maybe different factors in play. Some headwinds, obviously, is the rising energy cost. It's definitely going to affect margins. Higher yields will definitely also impact the valuations of some stocks. Tightening liquidity conditions, that's also a hit for uh, stocks, and that's why we're seeing it under pressure. But then again, we've seen that earnings been resilient. Investment in AI remains strong, even in AI infrastructure, historically speaking. And we'll look at a very important chart. Geopolitical shocks did create a buy dip opportunity, and it was not a drawdown that lasted for long. Equities now are not pricing a collapse. They're pricing tighter financial condition. They are pricing a shift in sentiment, a pivot point that happened so fast that we needed to adjust fast. But then again, it's happening in real time, and that's why we're seeing this high volatility. What happens next? Before moving to possible scenarios and checking the charts, I wanted to show you how equity usually uh, maybe react to historic geopolitical shocks. The blue line we see here is Iran's war compared to the median. And as you can see here, so geopolitical shocks, they tend to trigger, a short-term pullback. We've seen that. A high volatility, still, we're seeing that clearly, but it usually doesn't last for long. And if we can see how it's been compared to previous shocks, some would consider this as a buying the dip opportunity. We have three scenarios, or maybe three time frames, that we need to be focused on. Phase number one, what we're seeing right now, liquidity is tight. US dollar is strong, but still its main resistance is being respected. We'll have a look quickly on its chart. Volatility remains high, and we're seeing pressure across assets. Phase two would be the transition. Real oil prices, are they going to last at this level? Will they feed into global inflation data? When we start to see that, then obviously inflation expectation will rise. Central banks will need to drop their rate cuts, or maybe move to rising their interest rates. Then we should see resolutions in a way or another. It always happens. It should happen again. Oil prices could fade in case of any, solution at Hormuz. then USD would have been, at its peak, and we would see its pullback. Gold should recover at that level, and equities as well. Dutch Bank shows us, as we said on this chart, that we see a full recovery within 6 weeks. So something to keep in mind, maybe what to watch from here. Three things, as we said: the US dollar, we need to see, is it going to break the 100 point or not? That's a major indicator. Then obviously oil. Are we going to see this gap between prices, whether it's local benchmarks, European benchmark, and the US crude oil? Are we going to see a collapse of this gap, whether to the higher or to the lower? Then we'll also have a clearer maybe outlook, and liquidity stress. How long it's going to last? Is it real? The credit flows, how long it's going to last? Please remember, we don't think the war right now is another Russian-Ukraine story. um, I think we're responding to liquidity stress in a market that's been overcrowded in trades, whether even in gold. We'll have a look at the chart as well and see how overcrowded they were. So obviously, um, or a correction was due and was needed. So now the main question is, who is forced to sell? That's a very key question now. Who is forced to sell, and who no longer has the liquidity to buy? That's the main thing. That's the main question. And whoever answers that faster will probably have great trades ahead. So let's have a quick look on the chart. Maybe we can start with the US dollar and then move forward to other. Okay, so let us have a quick look on the US dollar. As you can see, it's been moving in sideways. 100 point was the upper boundary of that sideway movement. And then once it dropped, that was the lower level. You remember, that's where we saw gold reaching its all-time high, silver as well. Since then, we saw, let me just move the screen to the side. We saw a clear rebound and an uptrend, clear uptrend on the US dollar basket. Even yesterday, when Trump tried to calm the markets with extra 10 days, it's tested the support level of this uptrend, but then it rebounded. It bounced from this level and is now very close to test again 100 point. That's a key level, psychological level. We need to check. As long as prices are still trading above the uptrend, and we are expecting the momentum to continue. In case of any shock, especially now we're moving to the weekend, supposedly there was 10 days or 5 days, right? It was a 5 days. Um, Maybe we're waiting for boots on ground on Saturday in case nothing or there's no updates. But now also another 10 days. Is it really going to happen or not? Maybe we're moving to the end of this week. We're not really sure what's going to happen during the weekend. So please remember as well, at IG, especially right now, we have exposure to weekend markets. So we can even hedge or you can enter trades during the weekend on oil, on gold, different assets, indices as well. So we can see how, in case anything happens during the weekend, will we be peaking above 100, or will it act again as a major resistance? Obviously, it's important for the markets, for the rebound in equities, not to see it spiking way above that level, but that's really important to see. Our in case of anything happening in the weekend, we might see maybe a phase two of what happened last Monday. Stronger dollar, then it might also affect gold. Another peak or a drop. Let's maybe look at the 4 hours chart to explain what happened on Monday. Obviously, after the first drop, end of Jan, from its all-time high, and that was liquidity flush. We saw a sustained uptrend, then we broke below that as you know um, the geopolitical tension rose in Iran. And on Monday, we saw this drop. As we said, it's probably economies that needed cash and trying to liquidate the easiest asset to liquidate, which is gold. Um, as you can see, it was almost a straight line down. There was no support, and then, you know, here with the US session starting, we saw a bit of a rebound. Levels that we're highlighting here are very important. They've been respected since this whole, uh, since, you know, let's see, for example, 4,600. Since January, it was a very important level, acted as a resistance right now. Then we dropped below it in case of any spike in the geopolitical tension, in case countries exposed most to higher oil prices needed cash again, we might see another wave of uh, selling gold. Levels to watch obviously would be 4,000 and then below that 3,500. Is it possible? Maybe. First, if we look at the monthly chart, we can see that prices drop almost 18%. When, technically speaking, when we drop over 20%, that's a bear market. So we are very close to this point. In case we drop below 4,000, then that's a bear market, technically speaking. Keep that in mind. It can only happen if another shock, if another need for liquidity rose during the weekend. Let's have a quick look on indices where most of them are now trading, or all of them are trading below their 200 moving average. That's also a clear shift in sentiment, a clear shift to the downtrend. They're all respecting a clear downtrend. If we look at the S&P 500, since reaching its all-time high, it's clearly in a downtrend. Now it's moving to try to retest the lower level of the downtrend. As long as the headlines are bad, as long as liquidity is still needed, we might see pressure remaining overall on indices, on risky assets, on commodities as well. The only flip of that story would be a resolution, or it would be maybe the markets believing Trump, moving to more diplomatic approach to the tension. And another important thing to see is, even though we're seeing prices maybe on a shorter time frame almost being oversold, whether it's gold, for example, which also gives us an idea that maybe we will see a bit of a rebound on the short term. If we go on a monthly chart, notice how crowded these trades were. Almost 95% of market participants bought gold last month. So imagine when the shift of sentiment happens and the reaction was needed on a very short time frame. That's what happens. Even to the most maybe famous trades. Notice how indices were also almost overbought. Everything was overbought. Nobody wanted cash, and now we're seeing this correction in real time. Um, it's very important to see first, as we said, the US dollar is it going to break? And that's a technical sign, very important technical sign. Is it going to break above 100? And then gold, is it going to go into the bear market? And in case this happens, obviously we will see um, uh, a quicker reaction, a FOMO reaction, and then we might see the dip that everybody would want to buy. Obviously, there's a lot of things to take into consideration. That's like a quick overview of what's happening, why gold is being sold, why maybe oil is not spiking as it should be. Maybe it's delayed, as we said. We need to maybe wait for more information. We'll follow also the markets with you on a daily basis on our WhatsApp channel, on our website as well. So please keep in mind, even once we're done with this live, you can ask us any question. We'll make sure to reach out and answer them. And we'll see you definitely next month. And we wish you great trades and see you hopefully soon.